Liquidity. What is liquidity? Liquidity refers to the buy or sell orders resting in a certain area. Liquidity can be in the form of buy side liquidity or sell side liquidity. Sometimes liquidity will be referred to as a liquidity pool since it can be looked at as a pool of buy or sell orders in an area. What is buy side and sell side liquidity? Buy side liquidity is where the buy stops are located. Sell side liquidity is where the sell stops are located. Why is liquidity important? Liquidity is an important concept to understand because this is a big component on how the markets operate. As you progress through the next couple of sections, you will soon more what am I obviously didn't word that right. You will soon learn more about how the banks use liquidity to their advantage and how you can tag along with them. How to spot liquidity. In order to see liquidity, it will be important to understand how retail traders think. Yes, we are all retail traders, but you have to think about what the majority of retail traders are doing. Most traders are reading previous price action and predicting how price will move in the future. This most likely means they are reading areas in which price bounced from in the past and take trades off of these levels. These levels are typically support and resistance levels. When continuing through the section, I have added a couple of examples for each liquidity examples. It is important to note that they will not always look the exact same each and every time. They are always ever so slightly varied and come in many different shapes and sizes on any and all timeframes. So as I said before, I will get into examples of how they all look and stuff like that. Although I cannot show you every single example because every single day the markets are different. They form different areas, they form different wicks, they form different candlesticks. But even though they are very different, so slightly each and every day, the concepts that I teach still apply to everyday price action. What is support and resistance? Support is a price point or level in which price cannot go underneath or a price reverses bullish. You can think of it as it is supporting price up to not drop lower. Resistance is a price point or level in which price cannot go above or reverses from. You can think of it as it is resisting price to not go higher. How to spot support and resistance. You can spot any support or resistance level when price is clearly rejecting or bouncing off of a level. In the image below, there is a clear example of price in consolidation. There is a resistance level at the top. Whenever price hits resistance, price bounces off of it and drops. There is a support level at the bottom. Whenever price hits support, price bounces off of it and rises. So in this example right here, we just have a simple marking or annotation of price in consolidation. At the top, you're going to have some form of a resistance line. As you can see here, based off the little bounce markings, you can see every time price hits resistance, it bounces downwards. The opposite is for support. Every time it bounces off support, it bounces upwards. And that right there is just simple support and resistance. Why is support and resistance important? Understanding support and resistance is important because this is how you will find where the liquidity is. You have to think about what every other trader is seeing on the chart. In the example of consolidation, you have to understand that every other trader looking at the chart sees the same thing. Everyone can clearly see there is a resistance level at the top in which price cannot break. They also see how price drops every time it hits it. Many traders will see this as an opportunity to sell and catch the next drop that comes. Everyone can also clearly see that there is a support level at the bottom in which price cannot break. They also see how price rises every time it hits it. Many traders will see this as an opportunity to buy and catch the next jump in price that comes. With that being said, you can now understand where these traders' stop losses would generally be if they were to take a trade from support or resistance. Let me grab some water real quick. Resistance and buy side liquidity. If a trader is taking a sell position at resistance, their stop loss will be somewhere above resistance. The idea is that if price breaks above, the sell prediction is no longer valid. That stop loss is a buy stop order. That means there is buy-side liquidity here. The more traders that are taking sells, the more buy-side liquidity there will be. You can never truly see how many orders are resting in this area, but you can assume where they would be based off of understanding how retail traders see the market. And the resistance example is right here on the right-hand side. So basically here, if you think about it from a retail trading perspective, a lot of traders will see this level of resistance. When they see resistance, they're obviously going to want to sell at resistance. And the more traders that see this level of resistance, meaning depending on how clear this resistance level is, the more traders will be there. And if the more traders are selling from there, the more stop losses there will be above those highs. It doesn't really matter exactly where their stop losses are because obviously we don't know exactly where they are, but we can understand that if somebody is selling at resistance, their stop loss is going to be relatively above those highs. Support and sell side liquidity. If a trader is taking a buy position as support, their stop loss will be somewhere underneath support. The idea is that if price breaks underneath, the buy prediction is no longer valid. That stop loss is a sell stop order. That means there is sell side liquidity here. The more traders that are taking buys, the more sell side liquidity there will be. You can never truly see how many orders are resting in this area, but we can assume where they would be based off of understanding how retail traders see the market. So the same thing but the opposite. If there is a very clear support line, there's going to be a lot of traders that see it. And the more traders that see it, the more traders that are going to buy from support. And the more people that are buying from support, the more stop losses there will be underneath those lows slash support. And those stop losses that we are picturing, we cannot see them, but we can kind of have an idea where they would be. That is what sell side liquidity is. Now that you understand what liquidity is, let's look at the different patterns that you may see liquidity as. The first pattern will be consolidation. As I have already gone over, there is a resistance level at the top of the range and a support level at the bottom of the range. Every trader will easily see this and attempt to buy low and sell high. This means buy side liquidity will be resting above and sell side liquidity will be resting below. The more touches each level has, the clearer the level gets. This means more traders will attempt to place trades at these levels and increase the amount of liquidity in the area. So pretty much everything I've said, just a little bit different of an annotation. Here I have the little blue signs showing buy side liquidity and the red signs showing sell side liquidity. One thing I'll clarify is the clearer the level gets, or the more touches each level has, the clearer the level gets. Think of it this way. If price makes a double top like this, yes, this is clear, but imagine if price does this. Does it like 10 times. 1, 2, 3, 4, 5, 6, 7, technically 8 right here. The more touches it gets, it's going to be very, very clear that this is a clear resistance level. And the clearer it is, the more traders that will see it. And the more traders that see it, the more traders that will sell at resistance. And the more traders that sell resistance, the more stop losses there will be above those highs. More specifically, buy stop orders, which is buy side liquidity. Example of consolidation on the charts. You can see the clear rejections from support and resistance, price drops from the resistance, and rises from the support. These rejections can either be wicks or candle closures, whichever looks the clearest for you and every other trader. So in this case, yes, this is a clearer example. You can see the wicks touch perfectly, and the wicks touch perfectly on the top side and the bottom side. As we go over real charts, it won't always be this picture perfect. The whole idea of it is that it's going to be in a general range. It's going to be general resistance or a general area of support. It always won't be picture perfect. The more picture perfect it is, obviously, the more liquidity there will be there because more people can see it. But ultimately, the markets won't always be this picture perfect. Once again, there will be ever so slightly varied each and every day on different charts. But the idea is still there when price is creating support and resistance and price gets stuck in a box. This is consolidation and liquidity rests above and below. Channels. Support and resistance can also be dynamic. This means they do not need to be perfectly horizontal. They can be angled in any direction. For example, it can come in the form of a bullish or bearish channel. They are called channels because of its channel or tube-like shape it forms. It looks like consolidation, but with a direction. Support and resistance are just about parallel to each other. I probably won't read all this. I'll read the first one to refresh my memory, what I say, and then I'll break this down. So a bullish channel. In a bullish channel, price will stay within the channel as it creates higher highs and higher lows. These higher highs and higher lows don't necessarily have to be structure higher highs and structure higher lows. As a channel is respected more and more, there will be a lot of traders that attempt to buy at the bottom level. They will see some form of bullish structure with a clear support level, holding price up and attempt to buy at this level and place their stop loss somewhere underneath. This means there will be sell side liquidity right underneath. The more traders that do this, the more sell side liquidity there will be. There will technically be some buy side liquidity at the resistance level, since some traders will attempt to sell at the top of the channel. They will see that price rejects and drops from resistance, so they will take sells and place their stop loss above. Although there will be some traders doing this, the majority of traders will be taking buys, as most traders do not want to go against the trend. Remember, many traders will clearly see a bullish channel and would not want to take sells. What's going on, Koi? Welcome, welcome. So right here on the bullish channel, what I'm saying here is price will be making higher highs and higher lows. Again, these highs, in this case, these look like structure, higher highs and higher lows, but when drawn a channel, it doesn't have to be structure, higher highs and higher lows. Just any form of highs getting higher and any form of lows getting lower. And if you notice, it's kind of like in a tube shape. They don't have to be perfectly parallel with each other. This is a picture perfect example, but the idea is still there. Price is in a tube. It's in consolidation with the direction. Rather than price moving sideways, like completely sideways, it's moving within that range, but upwards or downwards. So what I'm trying to say here is there will be a lot of traders seeing this. And again, even though it's not structure, a lot of retail traders will maybe look at it as structure. And if they see price going up, they're going to want to buy more than sell. Why do they want to buy more? Because if they believe price is in bullish structure and price is going up, they wouldn't want to sell. I'm not saying you can't sell, but the majority of retail traders will be wanting to buy. And if the majority of retail traders are trying to buy, they're going to put their stop losses underneath the lows / underneath the channel. There will be some traders that do take sells at the top because they notice every time price hits the top of the range, and I can actually just pull it up here, intermediate, liquidity, and here. In this bullish channel draw, there will be traders that see, hey, price tapped here, price tapped here. I want to sell here because it dropped once, twice, and this is probably the third time it's going to drop, right? But most traders will start to see, hey, there is a bullish direction. I see price touch, bounce up, touch, bounce up, touch, bounce up. So when price gets back on down here, they're probably going to want to buy more than sell. So I'm just bringing up this example because there will be sell side liquidity, buy side liquidity resting above, but a whole lot more sell side liquidity due to the fact that most traders want to buy with the trend and not go against it. Cool. Here's the bearish channel. It's the exact same thing, but we have downwards direction. Price is still in that range. Price is still giving you downward movement, but in this case, you have buy side liquidity resting above and below. But since price is giving bearish movement, most retail traders are going to want to sell. I'm not saying retail traders aren't going to want to buy at all, but most of them will want to sell because they see the trend as going downwards. Therefore, there is buy side liquidity resting above and sell side liquidity resting below. Once again, I'll reiterate again. The clearer this channel is, the more liquidity there will be. Just like the clearer the consolidation area is, the more liquidity there will be. So same thing here. Now, examples of channels on the charts. So here are a couple examples. Again, these won't always be picture perfect. As long as price is relatively within this pattern, it doesn't have to be perfect wick touches. You could use candlestick closures. Overall, the clearer you see this channel, the more traders that will see this as well. But all the channel is, it looks like consolidation, sideways movement, but rather than just going completely sideways, you have direction. Price going upwards or downwards while price is still relatively in that tube-like shape. Compression. Compression is very similar to a channel. The difference is that price has more movement in the beginning and begins to decrease towards the end. The support and resistance levels will not be parallel to each other as it forms a triangle. So going back to channels, the biggest difference is these support and resistance levels are just about parallel to each other. Again, here these are picture perfect examples of them being completely parallel, but they won't always be picture perfect parallel like these examples. Compression is going to give you more of that triangle where price action in the beginning is very wide, and as price progresses and moves forward, it starts to kind of shrink, and that's what forms that triangle. So if you notice, bullish compression looks very similar to a bullish channel, but the difference is you have that compression. You have price compressing together, getting smaller, getting shorter, and forming that triangle. Bullish compression is just price compressing but still going upwards, and bearish compression is the exact same thing but price going downwards. Same thing applies. Most people will see this as bullish structure or some type of bullish movement, so there'll be more people buying than selling. Why? Because thinking about it from a retail trading perspective, most traders think trend is the friend, which I'm not saying is wrong, but they wouldn't want to sell against bullish price action. Same thing with bearish compression, which is just bearish price action. Most people would want to sell rather than buy. I'm not saying nobody's going to buy and there's no liquidity resting underneath. What I'm saying is there's going to be more liquidity to the upside, in this case, buy side liquidity. One example I don't have on here, I would still classify this as compression, but technically you could get an example where you have like a perfect triangle, whoops, where it does something like this. In this case, you don't have a sense of direction. Usually compression has direction going up or maybe direction going downwards like this. But if there's a situation where price is genuinely going down the middle and doing something like this, then you could argue that there is an equal amount of sell side liquidity and an equal amount of buy side liquidity. Because since it's in the middle, people are going to see this as opportunities to buy and opportunities to sell relatively the same. Examples of compression on the charts. Once again, a couple different examples. They don't always have to be just like this. It doesn't have to always be just touching the wicks. If price is generally compressing in a certain direction, this will be classified as a form of compression. Trend lines. Liquidity can also come in the form of trend lines. It is another example of dynamic support and resistance. The only rule to drawing a trend line is that it must touch any two highs or lows in the market. These points can be wicks or candle closures. With that being said, you can draw a trend line almost anywhere on the chart. I highly recommend to only draw them when they are very clear. Remember, these lines should be easily seen by any traders. If it is a trend line that only you can draw and see, then it most likely is not seen by other traders, and there won't be liquidity there. Do not force a trend line. The more touches it has, the more liquidity there will be. So, here, to give you a couple examples, don't try to force a trend line you can't see. So, for example, this could be used as a trend line. Why? Because you can see relatively some 1, 2, 3, 4 touches. Again, it doesn't have to always just be wicks. It doesn't have to just be, oh, this touch here, and this touch here, and this touch here. This isn't part of the trend line. Overall, just think about where traders are genuinely drawing the trend line. The ultimate goal is to identify, hey, there's liquidity resting above here. You know, I would not try to force something silly like, oh, here's 2 touches here. That's a trend line, right? And then you're like, oh, there's a trend line from this wick down to this wick. Oh, there's a trend line from here to here. Oh, there's a trend line from this wick to this wick. Oh, there's a trend line from this wick to this wick. It doesn't make any sense to just be drawing random trend lines. What you want to do is draw the trend lines that everybody else can see. So don't force trend lines. Draw the trend lines that everyone else sees because that's what you want to see in order to identify liquidity. Here are a couple examples of a line chart. Oh, actually, did I draw? I just went over this, yes. Here are a couple examples, and I kind of already went to the charts, but here's just a basic comprehension of it. You have sell side liquidity resting underneath the lows, because if you have a bullish trend line, people will be trying to buy off of it. It also is known as a form of support, more specifically dynamic support. A bearish trend line is a form of resistance, more specifically dynamic resistance, and people will be trying to sell off of here. Therefore, there will be buy side liquidity resting above. Examples of trend lines on the charts, kind of went over that a little bit, but here's just a couple of examples. Again, it doesn't always have to be picture perfect wicks. Just draw a general area where people are generally drawing the trend lines, and that's how you identify liquidity using a trend line. Equal highs and lows. Here, let's see. I'll read these ones. With equal highs, price will simply create equal highs. There will be traders that trade double top patterns. All this means is that they are anticipating an M shape to form and attempt to sell the second touch. They see the first drop price created and will draw a line of resistance and attempt to sell the second touch as they anticipate price to do the same thing again. When price does this, their buy stop will be resting above the first high. If traders do not catch the double top formation, more traders will anticipate price to touch resistance for a third time and attempt to sell here. The more touches there are, the more stop losses there will be above the equal highs. The more buy stops there are above the equal highs, the more buy side liquidity there will be. So here, equal highs. So pretty much you have highs that are relatively, well, I shouldn't say relative yet because I go over relative equal highs next. But equal highs that are basically at the same price point. Typically, when people see this, they call this double tops, which I'm not saying it's not a double top, but people, when they see this, when they see that first top, they will want to sell that second top. They see that, hey, price dropped here the first time, so I'm going to draw a line of resistance, and I think price will come up to this high, and they will look to short and do something like this, right? If they miss this short and price drops here, they have more confirmation that, hey, this is that double top or that M shape that they're looking for. And they say, okay, great, this is a very nice level of resistance. When price comes up here again, I'm going to look to short. So seeing equal highs is a form of liquidity. The more touches the equal high has, or the more equal highs there are in an area, the more liquidity there will be, because the easier it is to see, the more traders that are willing to trade or willing to take sells there. And the more traders that are willing to take sells there, the more stop losses there are resting above. Equal lows are the same. Some people look for a pattern called double bottoms. They are trying to buy at the second touch after price makes that first touch. If they miss that first one, they will wait for price to pull on back and maybe catch the third one. So equal lows are another form of liquidity, more specifically sell side liquidity. Examples of equal highs and lows on the charts. So here are a couple of examples. You can see price makes a high here and then comes back on up, makes an equal high, and then continues to drop. Makes an equal low, goes on up, comes back, makes another equal low, and then goes on up. Again, I can only give you a couple examples because I mean, I could give you 10 examples, but every single day, each chart is going to look differently. But every time you see me refer to equal highs, it's going to apply to with these concepts, basically. Relative equal highs and lows are basically the same thing. The only difference is they aren't exactly in the same area, meaning they aren't the exact same high or they aren't the exact same low. They are just relatively in the same area. So therefore, you can call them relative equal highs or relative equal lows. Most of the time, you will see relative equal highs and lows more often because the market doesn't always make picture perfect setups where they make picture perfect highs and picture perfect lows right equal to each other. So most of the time, it's going to be relative equal highs and relative equal lows. Examples of relative equal highs and lows on the charts. Here's a couple of examples. As you can see, here is a high, and this high, I'm not sure. Can you guys see my cursor? I don't think you guys can on Discord, huh? I know TikTok can, but you guys can answer this one if you guys can or not. You guys there by chance? You guys hear me?
Yeah, I'm here. Weekend.
You can see my cursor?
No.
Okay, you can't see my cursor. Okay, so I'll just pull up the chart.
Yeah, but for me, I'm having the TikTok on the side, so
I see. Okay, cool.
yeah.
Here, relative equal highs, you can see that price doesn't make the exact same high. This high is here, but this high is here, not on that same level. Therefore, they are relative equal highs. relative equal lows. They are not on the same level. Here's this low here, and the low is a little bit higher. So not equal lows, they're just relatively equal lows. So you guys cannot see my cursor on TikTok either. Interesting. Well, hopefully this helps me drawing these dots and stuff. And if you guys want to draw the annotations on TradingView like I do, here are the annotations. Simply put, when I am trying to draw liquidity on the charts, whether it's a trend line, whether it's relative equal lows, whatever is compression, whatever it is. For example, if I am trying to draw this as liquidity, I can maybe either use a trend line like this, or I can just classify this as relative equal highs. It doesn't really matter exactly, but if you go ahead and double click here, click on template and liquidity. Again, I know I have this template here, but if you follow these directions right there, you can have my settings how I draw it. But obviously you can do it however you want. Any questions on there, guys?
No, I'm good.
Beautiful.
I mean, I don't know if it's relatable or not, but I have one.
Go for it.
So yeah, I saw one of the member in our Discord mentioning about the angles so that we know
Yeah.
if it's liquidity or not for multiple touches and three touches. So is that like how would it relate? Is that considerable or how what
If
do you
you
think?
want to consider it, you can be my guest. Me personally, my rule of thumb is if it's clear to see, I don't really care if it's a 45-degree angle, 49.5-degree angle, whatever it is. I'm just looking for the clear trend lines. But
Okay,
also, too, I think if you use angles, I don't know which one it is, but technically, there's a trend line angle. Let me see. Yeah, like if you want to use this trend line angle,
okay.
sure you can. But I'm not
Uh,
going to sit here and say it doesn't work. All I'm gonna say
okay,
is like I don't need it in order to
okay.
identify a trend line. So like for example, I will agree that like if your trend line's like this, which is
Yes,
definitely above 50 degrees, whatever he said, I would agree.
yes.
But at the same time, even if price is here, I don't classify this as a trend line. Yeah, it can be a trend line. Someone's going to look for buys here, but I'm looking for the clear, distinct trend lines. The ones that do something like this. This is a bit more clear to me. People see this a whole lot clearer than anything else, you know?
Okay,
So if you want to back test and test based off of the angle itself, the numerical value, be my guest. But me personally, as I just taught you, I'm just looking for the things that are clear. So that's how I do it.
okay,
Because ultimately, trend lines are just an identification of a liquidity. So if I can see it, it's pretty clear as liquidity. Make sense?
yeah, it does.